Hello everyone, welcome to another episode of In Conversation by Advisor Coach. Today in conversation, our guest is Mr. Deepak Ramaraju, Senior Fund Manager, Equity with Shriram Mutual Fund. Deepak has over 20 years of experience, of which over 16 years of experience he has with equity markets. Prior to joining Shriram Mutual Fund, Deepak was advising Sanlam Group of South Africa on their India-focused funds and was also part of their global equity research team. Welcome, Deepak, to In Conversation by Advisor Coach.
Thank you very much, Suren. Thanks for having me on your show.
Our pleasure. Thank you very much. So, Deepak, just to begin, could you please tell us something about yourself?
So, I'm a chemical engineer by academic qualification, born, brought up in Bangalore. Now recently moved into Mumbai, part of the mutual fund industry now. So, I started my career in a pharmaceutical industry called AstraZeneca Pharma. So, started with pharma production there. And then from there onwards, I moved into Millipore, India, into development of filters, designing and sales of filters, basically for industrial applications.
Okay.
So these two companies were a short stint for me for almost a year. And from there onwards, I joined General Electric on their plastic divisions on the research front. So I joined them as a chemical engineer, and then over a period of time, been working on polyesters for 5 years in GE. So have 10 patents in my name on process and as well as new product developments in GE for the global markets. So after that, I joined the financial services industry, joined an Australian small cap company as an equity research analyst. So from there onwards, I've been the company took over by Sanlam Group of South Africa during the global financial crisis. So this was in 2006. So from 2006 onwards to 2008, I was the equity research analyst and then became the deputy head of research for the same company on the Australian small cap base. And in 2008, during the global financial crisis, Sanlam took over this small cap company in Australia. So that's how we became part of the entire Sanlam team of South Africa, basically. So we had a team of 7 people initially. Then over a period of time, we expanded the team. And at one point of time, we had almost 121 people working in the organization. And it was an equity research team completely supporting 7 fund managers across Sanlam globally. So that's how I was the head of research for the entire team at that point of time. And eventually, over the next 5 years, I continued to work with different fund managers globally and different styles, basically. Some are pure value oriented, some are working on thematic schemes, and some are working on specific focus kind of funds. So we were supporting different fund managers across the globe. Sure. So we have covered the entire global markets except the Latin American and Russian markets too broadly. Leaving that, we have even covered the European markets, the US, the Indian market specifically, and as well as Asia Pacific, and as well as the Australian company, including the Sub-Saharan Africa. So we have seen the most liquid market or the most illiquid market of Sub-Saharan Africa. So after this 5 years of experience, so it so happened that Sanlam started looking at consolidating its investments across the globe. So they had also started a kind of fund in India, which was India-focused fund in 2010. So it so happened in 2013, I started advising this fund. So after 3 years of this fund getting incorporated, so this fund came to me on an advisory basis. I was elevated as a fund manager and on an advisory basis. I started advising this fund from 2013 onwards. The fund size was $13.2 million, and then we took it up to $42.2 million over the period of 4.5 years, almost 3 times return during this phase, and won the Best Fund Manager Award in 2016 for the Raging Bull Awards for the Far East region in South Africa. This was in 2016. Then 2019, I was elevated as the interim CIO for Shriram Life Insurance. So Sanlam is a major shareholder in Shriram Group. So Sanlam holds 26% stake in Shriram Group. That's how I was also part of the Shriram journey since 2013 onwards. Sure. So 2019, I was brought in as the interim CIO for Shriram Life Insurance. From then onwards, like post-COVID, we acquired Way2 Wealth in Shriram Group. So I was also involved in part of Shriram Way2 Wealth at that point of time in setting up the PMS business and developing a new fund for the PMS at that point of time. Yeah. And recently in 2022, in the AMC side of Shriram AMC, so we got new shareholders coming in on the board. So that's when the team was revamped and then the entire rebirth of Shriram AMC came into place in 2022. Yeah. So that's where I was roped in as a fund manager for this entire new journey of Shriram AMC. So from August 16th of 2022 onwards, I've been on board with Shriram AMC actually. So I've been heading the equities here and managing all the equity schemes here in Shriram AMC. So that's been my journey. So it's almost more than 20 years of stint as of now.
Sure. Very interesting. So, in fact, we've been hearing a lot about Shriram going through a lot of transformation as we hear Shriram 2.0, right? So, through you, would also like to know about the Shriram AMC's pedigree, the group. You could also let us know about the group companies, as well as what is this Shriram 2.0 in terms of the transformation and what kind of vectors this transformation is going on through.
Sure. Shriram Group, as many of us know, it's a 50-year-old company, the financial conglomerate in India.
Yeah.
So it started off on the chit funds and eventually diversified into lending business, especially into truck finance. It's a market leader in the truck financing business. And after that, we have also diversified into life insurance and general insurance partner with the Sanlam Group of South Africa. And Shriram Group as a whole had a AMC license in 1994 onwards. Yeah. So they had started an AMC business since 1994, but they predominantly kept it on maintenance mode because the focus was more on the lending side. So the focus was more on the lending business at that point of time. So over the period of 20 years, they just kept it on maintenance mode. In 2013, they started the phase one of the launch of Shriram AMC at that point of time. So they started off with one equity scheme, but eventually the group focus still continued to be on kind of focused on the lending business, and then they continue to do that. Only post-COVID, when once the markets have become kind of very active from an equity perspective, that's when Shriram Group became more serious on the entire equity market space. Mm-hmm. That's when we started getting a new partner into the Shriram AMC side. And at the same point of time, the Shriram Group as a whole has been kind of more active in the wealth distribution business as well. That's why we acquired even V2 Wealth as a distribution partner and a broking company into our entire chain actually. And the focus on the group was also kind of been emphasized now. The Sanlam is also very serious, and as well the main promoter Shriram is also very serious on the capital market business. So that's when we got a new shareholder at the AMC level called Mission One Investment Partners.
Right.
So Mission One, this happened in 2022. So Mission One is 6-member kind of team actually. They are like ex-CIOs or the senior fund managers across the globe who had kind of a significant stint in developing the fund management business across the globe. They joined together and developed a specialized company called Mission One Investment LLC. This is based out of US. These guys took 23% stake in the entire Shriram AMC business because they were also looking at setting up an AMC business in India. And they found that they were also close to Shriram promoters at that point of time. They found that it was an interesting journey for them also because they were ready to get a license. Instead of applying for a new license and waiting for a couple of months or years to get the approval, sure, they were already getting a kind of ready to kind of operate kind of a business here. So that's when they took 23% stake in this business. They pumped in capital. And at the same time, Shriram also pumped in capital at the same point of time. We increased the capital base. And that's how the entire Shriram for AMC, it became the 2.0 version in 2022. So we got a new management in place. Karthik Jain, who is ex-HDFC and as well as DCB Bank. He joined us. He's an IIT and IIM pedigree. And he joined us as the managing director and CEO for us. We got Chetan Doshi during the early of January of this year. So he joined us from NSE. He's been having more than close to 20 years experience, to more than 2 decades of experience in the capital market business. So Chetan Doshi joined us as a chief business officer. We have Jaya Inani, who is from an auditing background. She joined us as a CFO for the company. And I was part of the Sanlam group in the journey. So I was roped in as the senior fund manager and head of equities basically for the entire mutual fund business. So this is the new team that is there, and we have been expanding the team both on the investment front and as well as the sales front. So we're strengthening fortifying the entire operations and as well as the back end. So it's a new journey for us. We started off in 2022. It's a long way for us now.
Wonderful. It's a lot of transformation. Yeah. As we rightly say, Shriram 2.0 in terms of taking the business ahead. Yes. For the last few quarters, Deepak, we've been hearing a lot about the enhanced fundamental model, the EQI. So could you tell our viewers a bit more about the EQI as well as the investment management process and how the EQI has actually helped in enhancing the performance?
So basically, when I took over as a head of equities and as well as a fund management business here, so we also consulted with Mission One because they were having the global experience. So we were regularly consulting with Mission One and as well as other stakeholders in the group. So one thing was very clear, to be a successful company in this entire business, the being a 47th company, the entire value chain, and after having 30 years of past experience of having the company presence. So it was kind of clear that we had to deliver sustainable alpha in the business. If we don't have sustainable alpha, we're not in the right kind of business in this the entire mutual fund space. So that was the kind clear-cut target set to me as a fund manager. So the idea was to use a differentiated approach. So come out with a kind of differentiated process altogether. So that's where we developed something called enhanced quantamental investment. We shortly call it as EQI framework. So it's enhanced quantamental investment framework. Here, what we do is we look at both quants and as well as fundamentals as a kind of marry both quants and as well as fundamentals. Within the quants, we are looking at different factor models, machine learning, and as well as AI. So in the initial phase, we are just working on the factor models as of now. Over a period of time, we are working on the back end on the machine learning and AI, which will be integrating along with the fundamental aspects. So on the fundamental aspects, as we all know, it's all like top down and bottom up, doing the value picks on the bottom up strategies and different approaches there, or all the derivative strategies. These are all some of the fundamental strategies that we run. So it's a combination of all these things put together. We have developed this called as the enhanced quantamental investments. Right now, what we did is we backtested the entire strategy for 20 years. So now when I tell backtested, it's more like to do with different factor models. We tested all the factors there. What we found was momentum, volatility, and value giving a better edge compared to other factors in the current market scenario. Because we are going through a significant volatility phase in the markets. To counter that, we needed a kind of low volatile kind of a factor and as well as momentum, because momentum delivers the alpha in the longer run.
Sure, yes.
And we also wanted to keep the portfolio relatively cheap. So that's where we want to have value as other factor into the portfolio. So momentum, volatility, and value, these are the three factors that we have in the EQI model. So as a basic factor model driven, it's a multi-factor approach that we have taken. The model will rank all the stocks in the universe and suggest us the top 30 or 40 stocks that we need to focus on. So what it essentially does is it reduces the bandwidth kind of for the analyst. So kind of take a focused approach rather than spending too much time in screening for bottom-up opportunities. It makes the focus research for the analyst rather than focus on certain set of stocks which are in momentum, which are having less volatility and kind of relatively cheap. So that makes the job of the analyst relatively easier.
Sure.
Now, that will be the starting phase for the analyst. With that, they actually start with kind of doing the fundamental research, understand more about these companies, why they are kind of coming into the momentum, or kind of they're having less volatility compared to its peers, or why they're trading cheaper. So we understand the story behind what's driving the story or of the stock for the performance of the stock. When once we are satisfied and convinced on the story behind this one and also the fundamentals of the company, we then take a call whether to invest in the stock or not. So that call is what is built a very critical aspect. So how do you pick the stock? So the fundamental factors, basically the momentum, volatility, and value helps us to identify the stocks. The fundamental overlay on that will identify the kind of analyze the risk. What is the what kind of risk that we are taking, and also this will also help us kind of improving the kind of performance of the companies or the portfolio over the longer run. So we take a blended approach here of both quant and as well as fundamental, and finally siphon it off, filter it down to the kind of 30 or 40 stocks into the portfolio. So this is the process that we are following. So now the best advantage of the EQI strategy is it helps us to time the entry and exit relatively better, rather than having a contrarian view and waiting for the markets to turn around and try to hold the stocks for longer run. So this helps us to time the entry and exit in a more precise way. That is one. Second thing is it reduces the amount of time the analyst takes to do the research. That's more an advantageous for the analyst to cover more and more kind of stocks and get a better understanding of the markets. And in general, the quant strategies help us to pick the winners and identify separate it from the losers. So you are more on the winning side. And historically, in the backtested strategies, what we have seen is 60% and 40% of hit rate. So 60% for the positive alpha and 40% of the time you deliver negative alpha. And what we have seen in our backtested strategies over the past 20 years, the 60% of the time when we deliver positive alpha, we'll take care for the underperformance in the 40% of the time. So overall, net to net, we deliver a positive alpha in the longer run. So if we take a 1 year kind of a time frame, at least 60 to 65% of the time we'll be beating the markets. 30% of the time we might be underperforming. So even in during these times, if we overlay that with the fundamental strategies and try to come out with some derivative strategies which can be counter to the market or kind of improve with the market, so we'll be kind of able to improve the performance over the model performance as well. So that's what we are trying to work on and then improve the performance right now. So right now we are able to implement the strategy from 1st of September. And from the time we have implemented the strategy from 1st of September, what we are seeing is the performance of Shriram Mutual Fund in the quartile 4 has improved to quartile 1 and quartile 2 subsequently the period of 3 months to 1 year period now. So that's the advantage that we have got, and we're able to consistently deliver on alpha. Short-term phases, we might underperform, but in the longer run, what we are seeing is the outperformance will definitely come in the strategy. It's a more disciplined kind of an approach, more process-oriented, and there is no subjectivity coming in. So the fund manager's subjectivity is not taking place, no emotional connect with any stock. So that's the main advantage of this entire fundamental approach here.
Very interesting. So September of 2023, you implemented this model.
Correct. 1st of September 2023.
And of course, I'm not referring to the last 3 years of the market, but one can easily say that from 1st of September 2023, we've seen all directions of the markets.
Correct. Yeah, exactly. So we are seeing much more volatility coming in the markets.
Absolutely. The volatility,
especially post-COVID, and after we had a significant rally post-COVID, that was because we were in low interest rate regime.
Yeah.
Now, as the inflation started picking up, the interest rates have also started going up. So that has made the markets more volatile.
Absolutely.
And the markets were anticipating more of kind of volatility to set in at this point of time.
True.
And with the recent geopolitical factors, the volatility is also taking a major toll on the portfolio performance as well. So to navigate this through this uncertainty, that's why we use low volatility as the primary factor, one of the primary factors in our quant models.
So just an extension of this question, the EQI model, it filters down the universe of stocks from what to what?
No, what we do is we are ranking all the stocks in the NSE 500. We are running this model across the NSE 500.
Okay.
So we are able to identify the large caps, mid caps, or small caps separately based on the CQF factor. Sure. And the allocation has also been suggested by the model itself. So how much we need to be in the large cap, mid and small cap, depending on the relative volatility of those segments and as well as the valuation of those segments. So the model suggests how much we need to be in large, how much we need to be in mid, or how much we need to be in small. So the allocation becomes dynamic with respect to the model, and it changes over a period of time, and the model relearns how the markets have been changing. If the market cycles suddenly change, the model starts relearning on its own. So when the volatility increases, automatically you try to bring in all the low volatile stocks, and when the valuation becomes expensive, so you try to identify the low value stocks and kind of make the balance, take a balancing approach there. So that's how this model works. It takes a relearning approach here based on the market cycles.
Interesting. Thanks for sharing that. So in the current market assessment, what do you believe would be the trends in domestic as well as the global markets? Briefly could tell the viewers in CY 2024 as well as 25.
Okay. So as we talk, we are seeing the inflation bit kind of being more sticky as of now. In the recent past, we saw the US inflation coming at 3.5%. The expectation is the inflation is going to remain sticky in the near-term future. One, because post-January, the entire story behind the inflation and the rate cut has changed. Because January of 2024 is when the Middle East crisis really brewed up, with Israel attacking the Hamas, and kind of from there onward, the entire Red Sea crisis has actually kind of increased the upward risk on the inflation globally. So because the container movement is being kind of hampered there, the entire traffic has to be rerouted through South Africa. That means to say the freight cost across the globe has been increasing. So that's impacting the inflation to a large extent. And also, this is also leading to supply chain disruption globally. That is the second factor. Third factor is with the enhanced kind of geopolitical tensions between the countries, what we are seeing, the crude price has also gone up, and also the dollar is being kind of becoming more stronger, and as well as especially compared to the certain emerging market currencies, we are seeing the dollar becoming more stronger and the inflation also becoming sticky. So that means to say kind of the commodity prices also on the up. That will further add to the kind of inflation going ahead. So this means to say the story behind the inflation is that there's upward pressure on the inflation. So turning back to November or December, the last year, especially 2023, November or December, the story behind Fed or the rally at that point of time in the markets was more priced towards the Fed cutting interest rate. Early interest rates, especially from June, July onwards in this calendar year. But now that story has been taken off because right now being the inflation being more sticky, we are expecting that the delay in the interest rate cut. That means to say we're not going to see any more rate cuts in this calendar year. At least I was expecting one rate cut to come in the last quarter of this calendar year. So now even that might seems to be a bit surprising after the Israel and Iran kind of crisis brewing up. So that means to say this delay in the interest rate cut is actually increasing the kind of volatility in the markets. One.
Yes.
Second thing is this geopolitical factors that are playing out right now. That leads to a lot of uncertainty, how the things will play out in the market. So that will have a kind of impact on the performance basically of the portfolio. So that's where we are like relatively more conservative on that approach. And more importantly, the proprietary model that we have developed, the EQI model that we have developed, that's where the low volatility factor will actually help us to navigate through this kind of crisis period and deliver a sustainable alpha in the long run. That's why we are more emphasizing that kind of low volatility as a factor there, because to navigate through this high volatile phases. So we expect the markets to remain sideways. We don't expect the markets to kind of take off in one direction. Neither we are going to see any major correction. Yes, we are heading for an election. We are in the election phase right now. The outcome of election, as per the markets, is kind of pricing in the India government to come back. But if there's any surprise, the markets can always take a kind of profit taking can happen in the markets. We can see some kind of correction happening in the markets. But again, there's a lot of ifs and buts to the kind of outcome of elections. Even if the India government comes in, we might see some kind of correction coming in the markets as well, because it's already been priced in. So given the kind of inflation being sticky and kind of the uncertainty coming, it all depends on what the new government policies will be, how the budget is going to be revolving around. But still, we are going with an assumption the India government is going to come back to power and we're going to see the same reforms stance from the new government to come in. That's what most fund managers are trying to position their portfolios right now.
Absolutely.
But any surprises, obviously there are going to be changes to the portfolio performances and kind of reallocations of the stocks would happen. They might take the defensive routes to a large extent. So that's our expectation on the markets in the for 2024 and 2024. I'm doubtful of any rate cuts coming in. I was expecting one rate cut in the last quarter. Now that also seems to be a bit doubtful.
Yeah,
25 years, depending on how the geopolitical factors play around, how the crude prices behaves and how the inflation comes down. That's when 2025, middle of 2025 is when we are going to see some kind of rate cuts. I don't even expect the first quarter of 2025 to see any kind of rate cuts, though there's an election in US as well.
Yeah.
The central bank in US might also be under pressure because of political reasons, but I don't see that kind of scenario also brewing because the inflation is going to remain sticky. But surprisingly, the major concern there is we're not seeing the job markets getting impacted because of all this thing. Job markets are relatively stable. So that's
very sticky.
The Fed is not in a hurry to cut the interest rates. So unless Fed cuts the interest rate, we're not going to see the emerging markets, central banks take a stance and cut interest rates. So it's going to be a lagging effect for all the central banks, especially in the emerging markets, for the Fed to take action. The US dollar is a primary factor. And once the currency will further weaken, if these guys go ahead and cut the interest rate, these currencies will further weaken and will have an impact on their inflations. So none of the emerging market central banks will be in a hurry to cut interest rate unless US Fed takes the first action. So that's where the story is as of now. So we are expecting the rate cuts to come sometime in calendar year 2025. So I don't see any major rate cuts coming in 2024 as of now.
Sure. So with this geopolitical situation, oil being extremely sticky, inflation being sticky, etc., do you believe in the short term, in maybe 2 quarters or so, it will have an impact on the corporate earnings and the earnings growth?
Corporate earnings is actually being stable enough in India. So we are seeing kind of good corporate earnings coming in because most of that is kind of back-ended now. So, but going ahead with $90 crude and crude at $90 kind of a thing, I don't see any major impact coming to the corporate earnings in India. So we still see the order books remaining relatively stronger for the
Okay.
companies. The manufacturing PMI and the GST numbers are reflecting that. And
Absolutely.
to be frank, India is more domestic oriented rather than export oriented now. The more focus is coming from the domestic demand. So most industries are catering to that. And yes, the exports are also being taken off better pretty well actually, because after the defense exports and the related exports, the major industry which are seeing a bit of setback is the IT sector. To a certain extent, the exports are relatively kind of, though it's stable enough, but the new deal wins, the further growth that we're seeing is kind of taken off a bit slow than expected. So we are seeing kind of a slower demand pick up in the IT sector. Barring that, even the exports are relatively strong because India has become the new manufacturing hub for the
That's right.
globe, with China being kind of on the
Seems like
backseat right
Quant,
now.
as we call it.
Yeah. So it's going to be India's story. So this decade will be the India story still. I don't see any major setback coming to the corporate earnings in
Sure.
the medium term or in the longer term.
Sure.
In fact, it's going to improve further on with the new government coming in and the government policies continue to favor the corporate earnings. I'm sure it's going to be kind of positive for the corporate earnings. So we are like kind of bullish in the longer run. Short term kind of volatility will still be there in the market. So that's where the markets are kind of playing around for Indians.
Sure. 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 Thank you for that. Could you also tell about some of the schemes which Shriram Mutual Fund has on the equity side? And do you plan to address the product gaps by launching new fund offers in CY 2024?
Sure. So currently we have 5 equity schemes. So 3 hybrid and 2 pure equity schemes. Within the hybrid, we have balance advantage, aggressive hybrid, and as well as multi-asset allocation fund. And in the pure equity schemes, we have flexi cap and as well as ELSS. Now, if you look at the kind of uh, the SIP flows or the lump sum money that comes into the entire AUM business of these 5 funds are actually covering almost 60% of the AUM of the industry.
That's right.
Large extent. So we are covered almost 60% from the market perspective, from the AUM share, basically the flow perspective, the kind of the lump sum flows or the SIP flows. Now we need to launch funds, especially in the mid cap and small cap categories. That we are going to do it at the appropriate time. So for Shriram, what is happening is we are in the 2.0 version. We are focused on growing the team, expanding the team. At the same time, we're also going to kind of set up the entire distribution network as well across the country. So kind of empaneling more and more distributors, working with the kind of third-party distributors and also tapping into the group as well. So we are focused on the group distribution network as well. So take a balanced approach and grow both the kind of verticals there, both the group distribution network and as well as the external third-party distributor. So that will
Sure.
be a balanced approach, what we'll be taking upon. And as well as we are strengthening the investment team, we are also adding more quant and fundamental analysts into the team. So with this, actually, we are going to be launching new funds in the calendar 2024. Time would actually, I don't want to jump this one right now and tell what kind of funds we're going to launch, but we'll be launching some differentiated kind of funds into the markets, something unique and differentiated funds as an approach that we are going to take here initially.
Sure, sure. Well, that's great to hear. Paneling new distributors to Shriram Mutual Fund, of course, and leveraging on the group strength for distribution as well. So keeping a very, very balanced approach in your overall distribution strategy, so to speak, to enhance the size of Shriram Mutual Fund as well. And of course, looking at
Correct.
interesting products to be launched in CY 2020-24.
Correct.
Could you
So,
also, tell our viewers about your investment management team strength, etc. The
okay,
size, number of people.
okay, we are a team of 9 people altogether in the entire investment team. I've been supported by 8 people along with me. So we have 4 guys on quant and dealers, basically. 4 team members who are working on quant and as well as dealing, and other 4 people who are working on the pure fundamental research. So this is essentially the kind of the entire team. And out of this 4 fundamental research guys, we have 2 fund managers identified, and we are expanding team. We are going to add more equity analysts and as well as fund managers into the team. So we are looking out for equity analysts and adding more fund managers. We are in the process of we have made some offers for few people, few fund managers as well. So they're expected to be on the board in the near term future.
Sure, sure. Wonderful. So great insights actually given by you today, Deepak, on in the entire group, the group strengths, the EQI model, etc. So what message would you like to give through this in conversation to the investors in the current market situation, as well as the mutual fund distributors, as well as the financial advisors?
Sure. So EQI model is actually a proprietary model that we have developed, and we are one of those companies who have been kind of only focused upon the EQI. That's a kind of as a strategy, and we are only fund house with EQI as a strategy. So many people might be following Quant in the process, but nobody is claiming that they're quantamental house as a fund house strategy. So, but
Sure.
we are the only ones who are claiming ourselves as a EQI as a quantamental strategy as a fund house itself, because that's been kind of what we have learned from the global markets, the performance, the experience of people from the global markets. Their inputs is what has gone into the kind of strategy, and we are kind of balancing both quant and as well as fundamental in our approach. We are continue to do that, and a kind of uh, we try to maintain a kind of balanced approach between both the strategies and kind of continue to deliver that. And it's going to be focused on sustainable alpha, and it's kind of more meaningful kind of, and as well as what do you call the structured way, or the kind of more structured process that we are going to follow. It's a process driven approach where we are looking at minimizing the kind of subjectivity of the fund managers, more objective kind of an approach that we have done. It's more numerically driven, reduces the time for the analyst to do the research, and then more focus on sustainable alpha in the near term and the medium term. So at any point of time, what we see is going to be kind of implementing the strategy across all the funds. Depending on the kind of funds that we manage, the universe of the stocks that we use for the funds changes. For example, balance advantage, we predominantly use large cap and mid cap stocks to a certain extent. For example, multi-asset, we only focus upon large, mid, and little bit of small.
Sure.
And similar case with hybrid as well. Whereas in case of flexi cap, we are looking at the NSE 500 stock, which is a combination of large, mid, and small. The best part is the allocation has been suggested by the model, how much we need to stay allocated between large, mid, and small. The model relearns itself. So it's not that we need to train the model every now and then. So it kind of relearns. There's obviously kind of innovation coming in this approach, and then we keep try to value add and try to work with different factors. We have mapped the different market cycles to different factors that are going to play around over a period of time. And that's accordingly, we will be changing the factors if we need it. And that's again depends on the broader economic cycles and kind of how the real interest rates move in the longer run. So accordingly, we have mapped that movement of different factors for different economies. So accordingly, we'll be running the quant models accordingly.
Sure. So what is that one message you would like to give to investors and distribution partners? Of course, the EQI model is definitely very, very interesting to know about Shriram Mutual Fund.
Sure. Though we have one of the oldest AMC in the country, so we are here to be in for the long haul. One. Second thing is we continue to deliver sustainable alpha. And then we are here for delivering consistent returns, and as well as kind of differentiated products, more which adds value to the investors rather than just developing me too kind of a products. Will be more kind of value oriented so that the kind of funds that we launch should have kind of value addition to the investors. We just don't want to launch all the Me Too kind of products and just fill up the categories. So we'll be like looking at developing certain more to just give an example, we might fill up the category of mid cap and small cap as a requirement, but we may not be in a position to launch all the sector oriented funds.
Sure.
We may not launch all the sector funds because sectors will have its own kind of ups and downs. So some of the investors who are invested in certain sectors, they may not be able to come out of other sectors when the sectors are in a downturn. So it doesn't make sense for them to stay invested across multiple sectors. So we'll be focused on delivering something unique kind of funds where we take care of the interest of the investors in the long run. So that's the bottom line of Shriram AMC.
Wonderful, wonderful. It has been great, Deepak, hearing all these insights about Shriram Asset Management, the group, the investment management process, the team, the plans ahead. Wishing you and the team Shriram Mutual Fund the very, very best for Shriram 2.0. Thank you very much, Deepak, for taking out time today from your schedule and having a conversation with us. Wishing you the very, very best.
Thank you very much, Suren. Thank you for having me on the time and listening to me patiently. Thank you very much.
Thank you very much. All the best. Thank you.
Thank you.